Protecting real estate investments in a dollar-declining crisis. The U.S. government's debt crisis. You should be aware that the United States government is currently facing an unprecedented debt burden exceeding $34 trillion. This staggering amount of debt is now costing more in interest payments than the entire U.S. military budget. As a result, significant questions arise about the long-term stability of the U.S. dollar and its implications on the real estate market. Understanding these shifts is crucial for navigating potential risks in the future. Footnote: the U.S. debt crisis presents serious economic challenges, affecting not only fiscal policy but also real estate investments. What happens when the dollar dies? Historically, we have witnessed the collapse of currencies, such as the Dutch guilder, the British pound, and most recently, the US dollar. The collapse of a currency is rarely a sudden, catastrophic event. Instead, it is a gradual process that eventually leads to a tipping point. The consequences of these shifts are not to be taken lightly, especially for investors and property owners. The shift from a dominant global currency to another system often leads to economic turmoil but can also create new opportunities for savvy investors. Footnote: currency collapses typically result from internal economic dynamics, such as inflation and excessive borrowing, leading to opportunities for well-positioned investors. Financial repression and inflation. The U.S. government faces a dilemma in managing the nation's debt. Raising interest rates to combat inflation could trigger an economic downturn, but failing to act would result in runaway inflation. As foreign buyers reduce their involvement in U.S. Treasury bonds, the U.S. must rely on inflation to ease the debt burden. This phase, known as financial repression, involves slowly chipping away at people's wealth through inflation, ultimately making debt easier to manage at the cost of the general population's savings. Footnote: financial repression occurs when inflation is used to reduce the real value of debt, impacting the public's wealth and purchasing power. Hugo Stennis and the power of debt. The story of Hugo Stennis, who capitalized on hyperinflation in post-World War I Germany, offers valuable insights. Stennis borrowed large sums of the worthless paper mark and invested in real assets such as mines and real estate. As inflation devalued the currency, the value of his assets soared, showcasing the potential of using debt strategically in times of financial instability. This example highlights how inflation can turn debt into a powerful wealth-building tool if managed correctly. Footnote: Hugo Stennis' success demonstrates how inflation, when paired with strategic debt management, can create significant wealth. The mechanics of financial engineering. The fundamental dynamics at play today in the U.S. economy are eerily similar to the conditions that led to past currency collapses. This is not necessarily about hyperinflation but about financial engineering. By locking in long-term, fixed-rate debt, you can effectively use inflation to your advantage. If inflation runs higher than the interest rate on your debt, you are essentially paying back less in real terms, even though nominally your payments remain the same. Over time, the value of your debt diminishes, creating wealth for the borrower. Footnote: financial engineering using fixed-rate debt in inflationary environments can lead to wealth accumulation, as debt becomes cheaper in real terms over time. The impact of inflation on real estate. Real estate serves as a hard asset and a store of value, making it an ideal investment during times of inflation. Rents tend to rise as inflation increases costs, and property owners benefit from higher rental income. Additionally, inflation erodes the real value of debt, meaning homeowners with fixed-rate mortgages benefit from reduced debt obligations in real terms. However, overleveraged investors or those with adjustable-rate mortgages may face difficulties if inflation drives interest rates higher. Footnote: real estate, especially when financed with fixed-rate debt, can be an effective hedge against inflation, provided the investor is not overleveraged. How to protect your real estate investment. To position yourself effectively in the current economic environment, focus on locking in long-term, fixed-rate debt. Avoid speculative investments based on capital gains and prioritize positive cash flow from rental properties. Furthermore, focus on markets with strong, stable demand and avoid over-leveraged positions. Having reserves and focusing on workforce housing rather than luxury properties can also offer greater stability in volatile times. Footnote: strategic positioning with long-term debt and focusing on essential housing markets can provide resilience in uncertain economic climates. The importance of borrowing wisely. In times of economic uncertainty, saving cash may not be the best strategy. Borrowing at low interest rates in an inflationary environment allows you to pay back the debt with cheaper money, effectively gaining wealth through time. This contrasts with holding cash, which loses purchasing power as inflation rises. Leveraging debt wisely can be a powerful tool in wealth building, particularly when inflation is outpacing debt costs. Footnote: borrowing in inflationary environments can be an effective way to accumulate wealth, as inflation reduces the real cost of borrowing. Investing in real assets. In uncertain times, the value of paper-based investments, such as cash, bonds, and pensions, can erode. Real assets, such as real estate, gold, and farmland, tend to hold their value and even appreciate in times of currency devaluation. By diversifying into these assets, you protect your wealth from the effects of inflation and currency collapse. Footnote: real assets are typically more resilient during periods of monetary instability and can provide long-term protection against inflation and devaluation. Global economic shifts and risk diversification. As global power dynamics shift and geopolitical tensions rise, diversifying your investments internationally is more important than ever. By spreading your wealth across different regions and asset classes, you reduce the risks associated with any single economy. Geographic diversification allows you to hedge against political and economic instability that may impact a particular country or currency. Footnote: global diversification reduces exposure to risks associated with specific economic systems or geopolitical situations, ensuring more stability for your portfolio.